Today's the day. You're very excited because not only is your house on the market ready to sell, but you've also received one or multiple offers on your property. Before you go and choose which offer is going to be the new buyer of your property, you have to weigh the risks and contingencies that come along with any and every offer. Contingency clauses are defined by Investopedia as giving one party to a contract the right to renegotiate or cancel the deal if the specific circumstances turn out to be unsatisfactory. Buyers in the agreement of sale have contingencies that they are including within their offer. So you have to understand what those contingencies mean. What is the level of risk that I accept this offer, that the deal does not go to settlement, that the deal falls through? How do I weigh those risks in the choice of which offer to go with? Every offer is different with the number of contingencies that are in play within the offer, and the house itself, the condition, location, and different utilities of the home will weigh the number of risks and contingencies with any offer. The number one contingency that comes into play is home inspections. Now there are 9 listed home inspections in the agreement of sale that the buyer has to either elect, saying that they are wanting to do this specific inspection, or waiving them, saying we are not going to do that inspection. There's also a section at the bottom of the agreement where they can write in other inspections that aren't listed in that 9 that they can elect. The biggest example is if they wanted to do a sewer line scope, basically an inspection of a sewer line for a public sewer system. As a seller, the more home inspections that are on the agreement of sale, the more chances the buyer finds something unsatisfactory, and they either negotiate or they terminate the contract. The number of inspections is important to the level of risk, but also which inspections are included also have a level of risk to them. Because if you're doing a septic inspection for an on-site septic system for a home that's built in the 60s and it might be the original septic system, the level of risk is high because the results might come back unsatisfactory, and that's one of your most expensive repairs that you have to do as a homeowner. Versus if an inspection is being done for insurances and zoning regulations because they just want to double check that they can get insurance on the home or the home is not in a floodplain. Very different risk, but it's still one inspection each. The weight of each inspection report is equal to how expensive the worst case scenario for that inspection is. According to National Association of Realtors' latest confidence index, they have determined in the last 3 months that 6% of contracts end up being terminated. And that's for all reasons, right? So 94% of the time, if an offer is accepted, they go to settlement. Of that 6%, 25% of the terminations go back to the home inspection reports because they are unsatisfactory and the buyer and seller cannot come to terms, and the buyer ends up terminating the contract. That being said, that is the number one reason for terminations is due to inspections. To make these numbers easier to understand, out of 100 homes that are under contract, only 1.5% of them are terminating the contract due to inspections. So it doesn't happen as often as people think. The second contingency that is the most popular because it is the most common within any agreement of sale is the mortgage contingency. Majority of the time, buyers are buying a home with a mortgage and they need the mortgage contingency in place because they need a mortgage to buy. They don't have enough money to buy it in cash, so they put a mortgage contingency in play. According to the NAR confidence index mentioned before, 21% of the times that a contract is terminated is due to mortgage related issues. Now that sounds vague because it is. There's a lot of different things that can come into play that will result to a termination from a mortgage contingency standpoint. For example, if the buyer's credit score happens to drop too low where they no longer can get a mortgage, that is right and protected for a buyer to terminate the contract under the mortgage contingency. Another example is if the lending company finds undisclosed debts that the buyer has to pay each month. That affects their overall affordability for a home. An unexpected reason, but it's why buyers have this contingency in play, is if a buyer loses their job while they're under contract. And because of that, they have to terminate the contract because they do not have employment. I've had it happen to me representing a seller, and it was heartbreaking because we knew how much the buyer loved the home and wanted to buy the home, but they were unexpectedly fired, and we had to put the house back on the market. An appraisal contingency is our third contingency we're going to talk about. If appraisal of the home appraises less than what the purchase price of the home is, buyers can then negotiate with sellers, and if they can't come to terms, they can terminate the contract based off the appraisal contingency. Let's say that the house is under contract, the purchase price of the offer was $350. And let's say the appraisal comes in at $340. We're at a $10,000 difference. That $10,000 difference is something the buyer would have to pick up on because the lender will not give a mortgage for more than what it's appraised for. So that $10,000 has to be negotiated between whether the buyer will take it or whether the buyer and seller reduce the purchase price to match the appraisal amount, or a meeting in the middle. Let's just say that it's $345,000 where they meet in the middle. If neither party can come to terms, that's where the termination comes into play. According to CoreLogic's latest study in July 2024, the report says that 8.6 of homes sold in June of 2024 had an appraisal value that was lower than the contract price. Again, only 8.6 of appraisals that were done, because there are cash deals where there's no appraisals. Another aspect of the appraisal contingency comes into play based off the second thing that an appraisal does. First thing is clear, they give a market value price, and that's usually where you hear most of the drama from. However, specifically governmental appraisals usually have stricter requirements for the home's condition. Those governmental loan types are like FHA, VA, USDA, need the home to be in a better condition than a home that is being purchased with a conventional loan type. An appraiser can come in and say that the condition of the home is not up to the standards of the mortgage that they're doing, and that the seller has to make these repairs before settlement could happen. And the appraiser has to come back out and approve that these have been made prior to settlement happening. In this situation, settlement might have to be delayed, or the seller has to scramble a little bit more to make sure that these repairs are done. But my fourth option, if it is in play of the agreement of sale, can have a higher risk in terms of a termination of the agreement of sale. That fourth option is home sale contingencies. So this is the scenario where the buyer who's offering to purchase your property needs to sell their home and use the proceeds from the sale of their home in order to purchase your property. So if they don't sell their home and it doesn't sell in the proper timing, then they can protectedly terminate the contract. There are actually two different types of the home sale contingency. There's the sale and settlement of other property contingency, and then the second option is settlement of other property contingency. What's the difference between the two? First one is sale and settlement contingent, which means the property either isn't on the market currently and they need to find a buyer, or the property is on the market but they haven't received an offer or accepted an offer for the purchase of their specific property before they can even purchase your home. The second one is just settlement, which means they already have an accepted contract agreement for the purchase of their current home, and in that situation they just need to make sure that that house settles in order for them to purchase your home. The sale and settlement contingency is much riskier because you have to either put the house on the market or it needs an offer to be accepted, and depending on where that house is located, the inventory might be high or houses don't sell quickly, so it might be a few weeks, a few months potentially before the house even goes under contract. So that's perceived as more risky because of the time it takes, the chance that it might not actually find a buyer at the specific price point that they need to sell it at or that they want to sell it at. versus the settlement, which is simply they've already done a lot of the legwork. However, they need to sell their home still. Might be some contingencies at play for the agreement that they have that could affect their settlement on their current home as in the buyer's. There's still risk involved in both. It's just the weight of that risk varies significantly because of where they are in the sale of their house. Now, the fifth contingency that comes into play is a smaller contingency, one, because it's not a part of every sale or every house, and also I rarely ever see an issue come about from this contingency, but it is possible. Option number 5 is the Condo and Homeowners Association's rules and regulations. Now, how is this a contingency? Can't say for all states, but specifically in Pennsylvania, buyers have a right to receive the rules and regulations of the condo or the HOA, and they have 5 days in order to review those rules and regulations. And if they don't say anything within those 5 days, then that contingency ends and the deal moves along. However, if a buyer has an issue with items that are on the HOA or the condo, they do have the right to termination as long as they do it with a written notice within 5 days. So it's important to understand, and it's important for both the seller and the listing agent to get those rules and regulations over to the buyer as quickly as possible. A lot of times the seller's gonna know, like, if they're selling their home and they had an issue with the HOA or condo, what that issue is and how it could affect the risk of a buyer not agreeing to the terms and terminating the contract. This is 5th on the list because it rarely ever happens and not all homes apply to this situation. I don't have specific numbers on the level of risk for this possibility because of how low it is, but it's still worth noting. If you have more questions about the home selling process, the home buying process, anything real estate, drop it in the comments. If I haven't made a video on it already, I'll be sure to make a video about your specific question. If you haven't done so already, please like the video and subscribe to the channel. Have a great day.